After the second biggest volatility spike since the great financial crisis, investors have been spending the past week looking for answers. That's our objective here on Market Overtime with David Rosenberg. Joining us from Rosenberg Research, the former chief economist on Wall Street, has some thoughts. And of course, we're going to get into the economy, the Fed, and more. David, thanks so much for being here on Market Overtime.
Pleasure, and thanks for inviting me on.
Absolutely. Okay, so we're coming off one of the biggest events here, really, I think a generation has basically seen, with the exception of the COVID spike. We just got the biggest vol spike since the GFC. How do we even begin? Is this the beginning of a major regime change?
No, I don't think it's a major regime change, and I think everybody knew that the Bank of Japan was going to start to snug policy. I think that they went a little harder and maybe sooner than a lot of folks were expecting. But you had to be living on a different planet not to know that the BOJ was going to come in. And with that, we had a very dramatic and swift unwinding of these global leveraged yen carry trades. From what I'm seeing, not all of it, but a good chunk of it has already been unwound. But I wouldn't say this is a regime change, but I would say that the BOJ is really the only central bank that will be snugging rates as everybody else will be cutting rates. And of course, that process has already started through much of Europe and Canada. The Fed will follow suit. So all roads will lead to a stronger yen and a weaker trade-weighted dollar ahead.
The dollar's been resilient through so much here over the last decade, really, and during COVID as well. We started printing money. We came to help the economy. The dollar ended up strengthening throughout a lot of it. That's where I do feel regime shift possible. There's been a lot of folks calling for a softer dollar for a long time. Does this kind of get that going in your mind?
Well, the dollar has actually been softening. It hasn't collapsed, but it's well off its peak. And if you look at the chart of the DXY, you'll see that it already has entered a downtrend. And what has kept it alive and well has been the fact that U.S. interest rates, for the most part, are so far above practically everybody else in the world. The Fed went harder on rate hikes, more than other central banks. And other central banks have started to cut rates ahead of the Fed. But I would posit that as the Fed plays catch down on rates to the rest of the world, and given how important interest rate differentials are for any pair trade, which is an exchange rate, that the U.S. dollar is going to enter into, I think, a prolonged corrective phase.
Does that look like it gets below 100 this year for the dollar index? Because that's kind of your post-COVID low of the range, whereas prior to COVID, dollar was down below like 90 on the DXY.
Well, there's an old trick of trade in the forecasting business is that if you give a time, give a time. If you give a point, never give both at the same time. So I don't know so much about timing it for December 31st, which is just, let's face it, a calendar quirk. But do I think we'll break below 100 sometime in the next, say, if you want, you call it 6 to 12 months? I fully expect it.
That to me would then seem like regime change, because the dollar has been holding on basically since the big run up through COVID. If it does break down, does that change what works? So far, dollar firm, big tech strength, U.S. kind of best house on the block has basically been the trade. What comes with the lower dollar in your mind at this point, David? What other things work in that regime?
Well, what will work will be a better tone to the emerging markets. Their assets should do better as their currencies firm up against the U.S. dollar, so they come out a clear winner. In terms of what would be a winner, say, within the U.S. equity market, technology will move on its own accord, but certainly export-oriented industrials and consumer products and healthcare equipment, a lot of that gets sent abroad, so you'll get some positive currency translation in those areas. And of course, anything priced in US dollars, whether it be commodities, precious metals, they should do rather well in that environment. I'm not going to go so far as to say is it a regime change. I've been in the business 40 years. I've seen multiple bull markets and bear markets in the US dollar. And we've gone through, as you said, a multi-year, you can call it a bull market. You don't have to be a technical strategist to look at the charts and know that the bull market in the U.S. dollar is over. So it's going to go through a corrective phase, as it should. Relative interest rate differentials will play a big role in that. But I don't know about a regime change. But as you said, there are going to be winners and losers, and those are the ones that I cited that stand out the most.
Stock-wise, David, what's your view right now? I know you resent the label some give you as a perma bear. I don't dwell on that so much. I can see over the last 18 months, you've had a few moments where it looked like you thought stocks were going to get hit harder than they were. Does that mean we're pent up for an even bigger sell-off? Walk me through the way you're thinking about equities right now.
Well, it's been a very interesting and unusual stock market because you had a handful of mega cap tech stocks carrying the load. And up until very recently, the average stock in the S&P 500 hadn't moved at all since January of 2022. So it was a very bifurcated, concentrated market. And I'm principally concerned over really two things. First are valuations, and I understand valuations are not a timing tool, but they do tell you whether or not, as an investor doing the math, as to whether or not you have headwinds or tailwinds behind you. You know, if you have a 15, 16, 17 multiple, you'll have a tailwind. When you're 20, 21, 22 on forward multiples, especially when interest rates are no longer zero. When interest rates are zero, the multiple can go infinite. That's Jack and the Beanstalk. But when the discount rate is 5% plus, the math changes. Now, market psychology and momentum and FOMO trading, that might not change. But when you look at the equity risk premium, say, which recently was as low as 40%, 40 basis points, now it's done some work up to 100 basis points. But historically, the ERP is closer to 300 to 400 basis points. So in other words, you're getting paid to be in bonds over stocks. People don't understand that. I know bonds are boring and stocks are very sexy, but equities have capital risk. Bonds might have different sort of risk, duration risk, inflation risk, Fed risk, but they don't have capital risk. There is capital risk in equities in terms of you can lose all your money. So you want to get paid a premium to be in equities. People right now, and for the past while, I'm just talking about the overall S&P 500, you're paying to take on the risk. You're not getting paid to take on the risk. And that's where I fundamentally differ with the legions of bulls that are out there. I think we want to respect the mathematics of relative valuation, not as a timing tool, but as something that you want to pay attention to as you're doing your risk reward analysis.
Sure.
So that's where I come out of it. I've been doing this 40 years, like I said. The two things that I've learned that are most important is you don't put all your eggs in one basket, and there is no such thing as a sure thing. So I don't believe in 0 or 100, and I'm not 0% in equities for the perma bear. Perma bears will tell you to go buy baked beans, barbed wire, and sawed-off shotguns to go dig a hole for yourself. That's a perma bear.
That's actually.
But what I'm saying is dial down the risk based on where we are in the cycle and where valuations are right now. Okay, and my biggest concern actually beyond valuations is that somehow, remember I said don't put all your eggs in one basket. That's a fundamental, basic investment tenet that I've carried with me through my entire professional life. But somehow this cycle with FOMO and TINA, that diversification all of a sudden became a dirty 15-letter word.
Sure. So
nobody is rebalanced. Nobody has taken profits. Nobody's rebalanced because greed has overtaken on the investment spectrum of human emotion. So to the point where more than 70%, this is unprecedented. This takes out the bubble peaks of 2000 and 2007. Over 70% of the U.S. household asset mix is concentrated in equities at a time when cash is paying you more than 5%. You can get short-dated investment-grade paper well above 4% without even taking on much duration risk. And yet, over 70% of the household asset mix is in equities. Unprecedented. For the baby boomers, for the people like me, the people that maybe aren't aged but are aging, we don't have time to ride out a bear market. Over 60% of the asset mix among the baby boomers who are in their 70s are in the equity market.
Yeah, it's
It
pretty
should be
compelling
30%
stat.
based on the life cycle, but it's just telling you that that's my primary concern is the hubris and the belief, the ingrained belief that the business cycle is dead, recessions are a relic of the past, and so are bear markets. We'll never see one again. That's the mentality today.
Well, I don't know if anybody should have that mentality. We had a bear market in 2022. David, I've got two points in there. One is more kind of about your process, and the other one may be a counterpoint to some extent. But firstly, about your process, because back to the baked beans and the barbed wire comment, one thing I have noticed about you is that you're not like a gold bug. I don't think you're like a big Bitcoiner. I don't know, correct me if I'm wrong, but it seems like the point about diversification is the table that you're pounding, generally more so than some of the folks who are very much kind of pitching a product, a singular product as a solution to this. Is it fair to say that income orienting assets is where you spend most of your time analyzing then? Because it seems like you like bonds within equities. Is that also kind of the approach? Do you like income?
Yes, especially in a phase where interest rates will be declining. And we already know that inflation is declining. People can argue, is it sticky, not sticky, but inflation's coming down. And I believe that at least for the next year or two, will continue to come down and stay low. And then we'll see in the next 5 or 10 years whether all this debate about deglobalization and return of worker power and all these other secular changes actually take place. But cyclically, and inflation is cyclical, it is coming down. The Fed has yet to cut rates. The bond market's been ahead of the Fed. Powell has signaled that the Fed will start cutting rates September 18th. So we're going into a new rate cycle, and yes, absolutely, it means that dividend payers, not just yield, but also dividend growth will be a primary theme. And as I said before, you mentioned about gold, and I'm not a gold bug, but I am very bullish on gold. My last trade, by the way, was buying silver coins. I did that last week. And you want to own precious metals when, and they're not income generators, but they have a very strong inverse correlation to the direction of the US dollar, which we covered, but also a inverse correlation with real interest rates, which are coming down and will continue to come down. So yes, I'm bullish on gold. You mentioned crypto or Bitcoin. Mm-hmm. Well, Bitcoin, gold is safety. It's a haven. Bitcoin is part of the risk-on speculative trade that you're seeing in a lot of the tech stocks. That's where the correlation is. And people say to me, well, but Bitcoin, it's digital gold. Okay, digital gold. Well, so you can buy Bitcoin. However, when you look at the relationship with gold over the past several years, if you believe that it is digital gold, it's got 20 times more volatility than gold has.
That's a great
point.
So
if you believe that there's some sort of relationship with Bitcoin and gold, just make sure that you have ice in your veins when you buy Bitcoin, or you try and draw the comparisons with gold. I gave a speech where somebody in the crowd in the Q&A said, I'm going to buy for Mother's Day a Bitcoin for my mother. What do you think? Do you think I should do that? I said, well, if you do, I would have a barbell with a pacemaker as you buy your Bitcoin.
I would have said, depends. Do you love your mother? I got one for you, David, to add into your tool belt, which is that the correlation between Bitcoin and gold, or volatility overlap, hasn't made any progress over its entire lifespan. So it's not even like it's getting closer to trading like gold. Now, another point, though, that I wanted to come back to, David, which is about equities. And I guess maybe the one counterpoint one could make to the putting your eggs all in one basket is arguably that over time, if markets function properly and the capitalist system works, then the biggest, best companies are going to be where all the money flows. And so I think about this past year where you've got basically a handful of stocks that invented this whole new way to process computing through AI, and you get this highly concentrated market that rewards all the index investors, and in some respect looks like basically the validation of the whole Bogle, stay in passive, let the market do its work for you. Don't try and be too creative. Is that a counterpoint then, or is that just a giant AI bubble?
Well, I think that if you're going to buy the market and do it through passive investing, I'd be more prone to say, buy an equal weight ETF the market because it's so extremely concentrated amongst a handful of companies. The market concentration is higher now than it was at the dot-com peak back in 99, 2000. So you have double concentration. You have concentration of equities in the household balance sheet. Once again, we covered that. But within the stock market itself, because it's cap weighted, you have intense concentration amongst a handful of companies. And I have nothing against technology, but I do have something against price bubbles. And I've just been seeing this too many times in the past. And yes, this is different than the dot-coms. These companies have business models, they have profitability, they've withstood the test of time. But remember that it wasn't just the dot-coms with no profits and no business model. Anything caught up with the advent and proliferation of the World Wide Web back in the mid to late 1990s, all these tech companies got caught up in it. Microsoft and Dell and Intel and Cisco. And those are real companies. They're still around today. And the price bubble burst. Those companies are still around. I mean, maybe we'll put Intel aside, but they're largely still profitable. And it took them many years to climb back out of the hole. So, I'm looking at the multiples. I'm looking at what's priced in. I did this analysis. We did it as our whole team. We went back to 100 years worth of data, okay, to see what is the embedded 5-year EPS growth in the S&P 500.
Okay.
Now, going back over 100 years, and you look at scrolled 5-year periods to see what is the 5-year embedded earnings growth, and it's 8%. That's the norm. And all of a sudden, a year and a half ago, NVIDIA comes out with its blowout report, and it's clearly the leader. Everybody's playing catch-up. However, that was a big inflection point in a lot of respects, but the markets always go and price in more than you're going to get. The internet was a huge game changer. It was like electricity. But the markets always price in more than you're going to get at the beginning. That's why elements of the stock market, especially the sexiest stuff, which is in technology or biotech, they tend to be very speculative. And so what we found was that in the past year, the stock market has gone ahead and priced in a 5-year EPS growth profile for the S&P 500 of 17%. Whew. More than double the historical norm.
Yeah.
Now, maybe it's right. Maybe that the generative AI craze and all its adaptations is going to be a bigger game changer than the internet was. Because the last time we had this much growth priced in, not on a 1-year basis, over 5 years, was back during the dot-com bubble. And we know what happened next. So I don't think this is sustainable. I think that there's no doubt that this will be a game changer. Maybe it's somewhere in between, I don't know, maybe it's somewhere between electricity and the internet, or is obviously an inflection point in the technology curve. However,
sure,
there's no evidence historically, going back a century worth of data, I think that's enough of a sample size, that this sort of embedded growth is ever sustainable.
Fair enough.
And then in today's market, where money moves so fast, it gets priced in a big hurry. So that just comes down to, when you talk about valuations, you're inherently talking about what is priced in.
Yeah.
And I just think there's too much growth priced in. Okay, so that's where I fall out in that particularly very large segment of the market. I'm standing by as an observer as opposed to a participant.
Okay.
And if we get the bubble bursting, I'll be a willing buyer at more appropriate price levels.
Where might that be? David, how will you gauge that? What's your kind of go-to? Is it just S&P level? Is it some of the big leaders? What type of correction would get you interested in nibbling, particularly in that AI stuff?
Well, let's talk about the S&P 500. What would get me interested? I'm not going to sit and wait for a 400 basis point equity risk premium, but I'll dip my toes. I'll dip more toes in. Like right now, in my personal asset mix, I'm 20% equities.
Okay.
Now, I know, I mean, people say that my hair is gray, but I like to say at $27 an ounce, it's really silver. But, where should I be? I should be maybe 40% equities based on my age profile.
Okay.
I'm at 20.
Okay.
I intend to get back there, but I think that once the ERP gets closer to 300 basis points where it normalizes as opposed to 100 basis points or lower, depending on the valuation metric you're using, I'll wait. Like basically, I am diligent, I'm disciplined, I'm patient. It does not bother me at all when my neighbor makes more money than I do in the markets. I know that it kills so many people to think that you're in the sauna with your tennis partner. He's telling you about just the killing he's made in Nvidia. It's just that I think everybody's become so short-sighted,
Uh,
and people do not look at risk-adjusted returns. They just want to drive the Lamborghini 200 miles an hour. I'm cut from a different cloth. And thankfully, I don't manage money for a living. I don't have to get graded at 4 p.m. every single day. Time is on my side because I have a longer time horizon for investing than a lot of other people. So I'm just not willing to be a buyer at these valuation levels. And if
Okay.
the market continues to go up, to me, it just becomes more overvalued. I want to wait really for the equity risk premium, and that's going to require two things. It's going to require interest rates to come down a lot more than they have,
Okay.
and it probably has to require, more of a price correction. But there will be a point where we'll get more interested. Absolutely.
If we hold all else equal, what does that equity risk premium calculation look like? If we just assume rates stay the same, what kind of sell-off would that require in stocks and for you to want to rebalance your own positioning up closer to what you want?
Well, it's you're putting me in the position of Jack Nicholson. Can you handle the truth?
We can
I mean,
handle
if you're looking at what would normalize the equity risk premium, I mean, you'd be looking at numbers like 3,500 on the S&P.
Phew.
Yeah, and probably 2% on the 10-year note. Now,
Wow.
now this is well, investing should be a process. It's not a lottery where you put everything. You should be investing with your view in mind, but understanding that everything's a shade of gray, and everything about investing is about a probability curve. And so I wouldn't wait for that to happen. I could start to get more interested with the 10-year note at 3% and S&P down towards 4,000, which
Okay.
is really,
All
where
right.
I'm expecting. I know people
That's a
don't
little.
believe that's
That's
ever
a little
going to
bit more
happen.
manageable.
Yeah,
2%,
but
35 is scaring me.
well, but that's the nature. That's the nature of the math. That's how. But I'm trying to explain. That's just how egregiously overvalued the stock
So-
market is, and I'm not just talking about in absolute terms, but relative to the risk-free interest rate. So,
Yeah.
look, the thing is that I'm not trying to pinpoint the ideal time to start going along the stock market. It will be a process.
Well,
The
like,
key,
I think
the key is to play the middle 60%. There's nobody I know, even Paul Tudor Jones. There's nobody I know that can time the market perfectly. That person doesn't exist. So you want to be disciplined and play the probability curve. You know what? I say much like Warren Buffett does. Play the middle 60%. Don't worry so much about buying at the lows or selling at the highs. And I would say that is just part of prudent investing that pays attention to the downside risk and protecting against the downside risk. So we're in a totally different part of the market cycle than we were, 2 or 3 years ago.
Yeah.
And based on my work, I'm not going to say it's impossible for the growth that's embedded in the stock market to come to fruition. Generative AI could be that big game changer. I'm just saying really double the historical norm on profitability growth is not impossible, but it's not likely. Ergo,
Yeah.
I'm not zero anything.
Right.
But I'm 20% in equities right now, and I'm not in the technology trade.
David, it seems like to kind of come full circle to one of the things you said at the beginning then, because if you're looking for these risk premium levels to kind of rebalance to traditional standards, it does seem like then you don't believe the Fed or whatever forces that we've been able to invent with monetary policy are able to contain the swings of the business cycle. Because one could argue that, all right, if we do have a better understanding of the economy to contain the business cycle swings, then that would mean equities justify a higher risk premium that would require kind of a tweaking of that calculation. So then is the implicit kind of call there then that we're going to get a sort of old school style recessionary hit? Are there any views on GDP you can give me for kind of the next year out? That's kind of the last point. Close us out on that. We got about 60 seconds.
Right. Well, look, I don't believe in new eras. I don't believe excesses are permanent, and I certainly don't believe that the business cycle has been repealed. I can understand that there's a whole host of forces at play, as there were back in 2006 and 2007, that thwarted the damage the Fed had done on interest rates. And it was a very similar interest rate cycle now compared to then. Back then, everybody was able to continue to tap their home equity lines of credit, their cash flow refinancings, right up till the end of 2007. Even after an aggressive Fed rate hiking cycle under Greenspan and Bernanke, people were finding ways to extract cash flow from the last vestige of the housing bubble. And I was really early on that recession call. But in the end, I was crazy early, but I was telling people carry an umbrella out with you, and then the storm hit in 2008. This time around, the cycle's been elongated because of the excess savings file caused by that massive $2 trillion stimulus check that Joe Biden gave everybody who had a pulse, even if you're high income. That was an Energizer bunny that kept on giving. And then, of course, we had the CHIPS Act and the subsidies, and manufacturing construction was huge last year. A lot of things on fiscal policy has given an extra life to the economic expansion. But I believe that in a credit-driven economy, which we are in, interest rates matter. We just came off the most acute tightening cycle by the Fed since the Volcker years of the early 80s. And what did Powell compare himself to? Who did he compare himself to? Not to Arthur Burns, God forbid, not to McChesney Martin, not to Greenspan, not Bernanke, all the way through compared himself to Paul Volcker. Paul Volcker crushed inflation with higher interest rates and ultimately a demand recession. And I don't think it's going to play out differently this time. The lags have been longer, and the lags, remember, long and variable, but we are not going to get out of this tightening cycle that we endured with a get-out-of-jail-free card for the economy, especially now that a lot of these sources of stimulus that were a very strong antidote to the Fed's rate hikes, they're in the rearview mirror right now. And what stares us in the face, and Jay Powell talked about this at the podium at the press conference after the last meeting, the lagged impact of what the Fed has done still stares us in the face. So I think that's part of it. Part of the multiple expansion, the earnings that people are willing to pay for, is premised on this belief that because the recession hasn't happened yet, it's not going to happen at all. That's like me saying in my perch in Toronto, if it doesn't snow in December, oh, don't worry, winter's been called off. Think about how crazy that is.
I like that. David, very enjoyable conversation. For all the talk, very reasonable stuff. And I don't even think I heard the word stagflation once. So if we made it 26 minutes without that word, and you can't be that big of a doomer. Appreciate your time, David.
You too. All the best.
All right. Thank you. Thanks again to David for his time, and thank you for watching Market Overtime. I'm Oliver Renick. Remember, you can watch all the interviews from this series at schwabnetwork.com and on our YouTube page. Thanks for tuning in.